because we have some athletes who couldn't join, but they want us to send the PowerPoint or the recording, so we'll do that. So we want to thank you guys for joining us today. Courtney, Alana, Kim, Asia, good to see you, or good that you joined. Asia, I haven't talked to you in a good minute, so it's so good that you joined. And then we have Grant Fisher, who's an athlete out of Oregon, training with the Nike camp. Thank you guys for joining us today. Originally at the beginning of the year, the beginning of the tax season, Lauryn and my team were planning to go out to Portland, Oregon to do a seminar with the athletes out there. But then, as you know, COVID happened and we had to postpone it. And then eventually we canceled it just due to the madness concerning COVID. But we still wanted to connect with the athletes and offer them some sort of seminar format, but more informal than what we were going to do in Oregon, where we give athletes a chance to just throw some questions at us. Especially since it's the end of the year, this is when we reconnect with the athletes to do some tax planning and kind of see where they're going to land, see how much they need to contribute to a 401k or the SEP plans. So we're gonna talk about all those things. We have Lauryn, the great Lauryn Williams, here with us. We've been working together for what, 3 years now, 3 or 4 years now, working with athletes together. It's been a great pleasure. It's been beneficial to, I know, my clients to have her on board as well to assist them with any type of financial planning questions and retirement questions and setting them up with retirement plans. She's been a true gem for my clients, and I appreciate her so much. So I'm going to allow Lauryn to present first. She's going to talk about some financial planning, I think maybe some budgeting and investing and planning for 2 retirements. I love her presentation on that. She's going to present first, and then I'm going to tag team behind her to talk about some of the tax stuff. But we're going to have some short presentations. It's going to be detailed, but it's going to be a little bit short because we want to allow enough time for you guys, the athletes, to answer or to ask us questions. Because sometimes I know when we present at the USATF annual meeting, we have such a short time to present and get the questions in that we don't always hit all the athletes or get all the questions in. So we really want this to be a forum for you to ask whatever you have on your mind. Okay, so I'll turn it over to you, Lauryn.
Well, good afternoon, everyone. I think you summed it up really well, Tanisha, and the idea that, like, one, you have the flexibility to be a little bit more informal with Zoom. People can join from all over the country and we can kind of chat it up a little bit. And half of the group here, so Alana, Courtney, and Asia have all met before in some forum or another. Kimmy and Grant are new to me, and I'm happy to share. Like I said, I'm going to go through kind of the slides, but knowing that the others have kind of seen them, I do want to keep things relatively short and go through what I think is going to be pertinent for this year as it pertains kind of to 2020 and what we're going through. So just to start out, we know 2020 has thrown everybody a lot of curveballs, all the curveballs.
So, 2020 threw us under the bus. That's what happened.
Right, exactly. And so I think the biggest thing that's on a lot of athletes' minds right now is, the uncertainty and how can I prepare for the uncertainty? And I'd say the best thing you can do is to really look at your expenses, take inventory of what you have right now, and to really ask yourself the question, what if no money comes in next year? What if, COVID round 2, like we all kind of got caught scrambling, but now we're in the midst of this. So how can you plan for worst case scenario and be really excited about best case scenario? And I think the main thing there is really getting an understanding of your budget. And if you even have a good budget in place, where do I need to make adjustments? Where, might I need to kind of sit on? As an example, I was talking to a client recently who wanted to make a home purchase and has decided not to have the home purchase and to keep that money as a down payment, liquid, sitting still as additional emergency money, because like I said, if there is no Olympic Games, their finances are going to be significantly different. So what goals and values and visions do I have for myself, and what can I do to reallocate my money in a certain way so that I can make the most of those opportunities? So I will, like I said, briefly go over my presentation, but the main thing I want to do is be able to answer questions for people. And I'll kind of, like I said, talk about things from the what happens if, what happens if 2020 turns into 2021, which now that we're in December, I think it's safe to say that, everybody's like, I can't wait for 2020 to be over. But that in and of itself is not going to save us. The clock is going to strike 12, but we're still going to be in the midst of this, and we need to start to just kind of make the best of it. So I always talk about this idea that there's this perception that we want the way we want to be perceived by people. It's kind of like, I have it all together, I got a plan, I show up, I don't talk to you about my money, and as long as I look like I got it together, then I must have it together. And that's kind of the straight line. I'm headed in the right direction. And then people come to presentations sometimes with the kind of secret agenda of, I know there's some things I need to learn, so I'm kind of down here at the bottom, but I'm hoping that Lauryn and Tanisha are going to give me everything I need in this hour so that I can fix it, right my ship, optimize my finances, and be up here at the top. The reality of the situation for all of us is life is all over the place. Things are happening. We're getting married, we're having children, injuries are occurring, 2020 is happening, and life is just all over the place. Whether you're making tons of money and saving tons, whether you're making almost no money and living paycheck to paycheck, everyone's life is some version of that scribble scratch over there. And the point being that you can get to the top and you can finish on top, but not to underestimate the idea that we're all trying to optimize our finances and make the most of situations and make the best decisions as life comes our direction. There's no one size fits all way to do things. So as I was talking to you all a little bit about the idea of taking inventory in 2020, you may have seen this part before, like I said, if you've seen the presentation, but where are you now and where do you want to be? That's a question that you can check in on year after year, month after month, at least twice a year. I would say you should be checking in on, what am I doing and what do I want to be doing? So there are always some things that we can be doing financially that would give us more peace of mind, and allow us to really focus on the things that we care about. So with the Olympic year coming up for summer games athletes, that's probably, I want to focus on the games. I don't want to be stressed out about where the next dollar is going to come from, so that I have what I need as it pertains to physio and coaching and proper nutrition, etc. So what can you do right now in the midst of off season or fall training that's going to give you peace of mind so that you can really focus on that heading into 2021? And then, like I said, where do you want to be? I'd imagine that'd be on top of the podium is one of the main answers. But what are you really trying to accomplish in life? Like, think 5 years down the road, think 10 years down the road. And it's really hard for us to do as young professionals because we're young, we're vibrant, we're living in the moment. But if we don't ever think about what we want for ourselves in the future, we can't plan accordingly and set ourselves up for the best future. So those are two questions I always challenge people to ask. There we go. Always, how do you get there? You first have to earn the money. It has to come in from somewhere. And it's not a bad thing to earn money. I feel like sometimes people kind of get the idea that you have to be like, I'm fighting a good fight, I'm struggling with everybody. And it's okay to pick up a second job if you need to earn more money. It's okay to not have a contract and, not be in a situation where, it's just raining money all the time. And you don't have to pretend that like this is the struggle. You can say, I don't want to struggle anymore. I'm going to go out and I'm going to find some additional income. And now more than ever, things have gone to online and, created a lot of opportunities for people to be able to work from home, work from a computer. And as athletes, we definitely generally need flexible scheduling. So don't be afraid to find alternative streams of income if money is not coming in from sport the way you want it to. Right. So first we earn and then we save. So the order is very important here because they said something has to come in first, but then we need to prioritize saving. And what I see frequently happen to athletes, the biggest pitfall that we bump into is we earn, we spend, and then we try to save what's left over. The wrong order of operations is going to be the thing that has you bumping your head and wondering why you're not reaching your goals. So we first earn our money, and then we know what our goals are. We've kind of mapped those things out. We know how much we need to save. So they always talk about the numbers don't lie. The one thing that's cool about finances is that it is very mathematical in some aspects. We can do calculations. If I need to save $12,000, I know I need to save $1,000 a month. Sometimes we don't do that math. We just say like, oh, I want to buy a house, and you start putting, the $200 that's left over every month. And then you realize like, oh, I want to buy a house this year and I can't, I don't have anywhere near what I need. You can do the math for whatever your goals are, set up your savings goals, automate those things. And then the best thing you can do is see, oh, okay, well, this is what I have left over. This is how I need to set up my lifestyle to spend on what's left over. If we do these three things in this order specifically, you will be successful. But you have to know what you're working with. So when I say, what are you working with? It's like I said, taking inventory. A lot of times people have the goal or aspiration, or they look at others and say like, oh, they're balling, they're making so much money, but more money, more problems. That is a real thing. And so, 100,000 is a number that a lot of people throw out. Like, I want to be a six-figure earner. And so I just threw a little thing here on the side that just like baseline shows you like, oh, you made it to the 100,000, but many people have agents that are 20% of their income. So already off the top, you're not at 100 anymore. You're already down to 80. And then let's just say, on that 100,000, you have to pay taxes. I know Tanisha will get into the nitty gritty, but I feel like that's a safe estimate of what you would have to pay if you're a $100,000 earner. And so that 100,000 immediately turned into $60,000. All that money that you make is not necessarily yours. And so you need to be thinking about like, oh, I have a $250,000 contract with Nike. That's great money, but how much of that do I actually get to bring home? And instead of focusing on, because we sometimes just kind of anchor to the number that we know is on our contract, as opposed to anchoring to what is our actual ability to be able to spend on a monthly basis in order to do all the things that we need to do. And then, not even just that. So we got the agent and the taxes are just the two big things, but we're business owners. So this 100K is not just a salary that's being paid to us that we get to do something with. We have business expenses. I missed there we go. Well, in the wrong order, but there's tons of business expenses associated. And I know Tanisha will, like I said, talk more about from a tax perspective, but these are all the things that also have to be covered to make sure that we can do our job appropriately. So now our $60,000 that was left over is being diminished by that. And then we need to live and, go to the movies and have a date and, live our lives, do things like that. So it's important to realize what you're working with and to be able to take inventory of what your finances look like and understand that, I'm not saying, woe is me, I make $100,000, but at the same time, that the money is that the gross number is not the net number, and you need to organize based on the net number. And the best way to do that is to have a budget. So I feel like budgets get a bad rap. They get a bad rap because people are just like, I don't want someone policing my money. I don't want to be policing myself in that regard. All budgets do is put constraints on people. I feel like it's the exact opposite if you budget appropriately. So one thing that I like to do with clients that are looking for the broad stroke of view of things is, like I said, what I call a bucket budget. So if you're looking here on the left-hand side, you see like you earned $1,000. So bucket wise, we need to be saving 20% of our income. That is best case scenario. We should be able to save 20% of our income. We're not always in that situation. If you're not in that situation, then like I said, save what you can, save first, and then, you have to spend the remainder. But depending on what your household expenses are, what your obligations are, et cetera, you should be trying to get 20% of your income saved in some sort, form, or fashion. Priority-wise, you should be saving for an emergency first, and then starting to save for your goals. So goals being things like retirement, vacation, home down payment, wedding, et cetera, so on and so forth. But emergency fund is the first thing that you need to get done. Once you've got the emergency fund funded, then you can move on to some of those other goals. But that 20% should always be going toward something saving for your future. And then the other 80% goes toward spending. So when we talk about spending, generally, it's a good idea to have about 50% of your income, no more than 50% of your income going to fixed expenses. So fixed being things like your rent, lights, utilities, things that are obligations and that you would have to pay whether you had a job or not. Those are kind of the main fixed expenses you should be looking at. So just because Netflix is $7 every single month and it's fixed, it's not necessarily a relevant, mandatory obligation. So when you think fixed expenses, think of the things that are not optional. Whereas the variable expenses are not just going up and down and may fluctuate, but they also are the things that you could get rid of if you didn't necessarily need them or if you were in a tight situation. So you want 50%, no more than 50% on the fixed, and then the 30% on the variable. Now, an important point to bring up is if you have debt. So when I say debt, I mean like the bad debt. So credit card debt, student loan debt, care credit cards, things like that, then you want to lower this variable expense and really be able to tackle your debt. So you get to have less fun, clothes, dining out, etc., until that debt gets paid off. And then you can give yourself a kind of lifestyle increase, making sure that everything is taken care of. So this is the quick bucket budget way. You can set up 3 different accounts, set up your checking account for major expenses, set up another checking account for your discretionary spending. So that way you can, all your bills are going to be paid. Then you have another account where you can YOLO and do whatever you want with it. And then you have a third account where your savings is going, and that's completely separate. And the best thing you do also is automate. So like I said, if you know you have $1,000 coming, send the 200 directly to savings, send the 500 directly to the checking number one, and send the 300 to the other. That way the money's already set up, ready to go, and you're ready to rock and roll. So simple things that you can do without having to, account for I ate a $3 cheeseburger, I ate a $2 ice cream, so on and so forth. But that's not a bad thing. If you want to account for every single thing you purchase, I do it. I love it. I may be a finance nerd, but there are tons of apps that allow you to do it. And the big benefit to doing so is that it creates awareness around your finances, because things do fluctuate over time. So I can look at my overall spending for the year and know that on average monthly, I spend like $600 a month on food. I can't know that because not every single month do I spend $600 on food. Some months I spend like $100, and other months like I'm out of town the whole month and I spend $1,000. But I know on average, and then it helps me be able to plan accordingly so that I know I have a certain amount set aside for food, so that when it does go up and down, there's money specifically for that. But You Need a Budget is the name of the app that I use, that it helps me account for everything. And they got tons of videos. They are very, very good at helping people like really get a grip on their budget. You can set goals, get a really good understanding for things. So you can do the bucket budget, which is kind of the easy way out, or you can do, the nitty gritty budget if you're into that. But like I said, the freedom you get from knowing exactly where your money is going, I think is a really cool thing. So we talked about these business expenses. And then we need to talk about this emergency fund a little bit more. So now more than ever, you probably heard about the emergency fund, but in 2020, this is the year that people really had to tap into it. So if you are an athlete, like I said, that is not a sponsored athlete, doesn't have any consistent income coming in, you depend very heavily on prize money or competition money, appearance fees and things like that. You kind of might have got knocked on your butt this year and needed to tap into your savings, needed to cut your expenses. And if you had an emergency fund, this was the thing that helped you quite a bit. And if you didn't have one, this is the thing that, sometimes people are just like, oh man, I wish I, coulda, woulda, shoulda set some money aside. So I say start by getting $10,000 saved up. Dave Ramsey's going to tell you to start by getting $1,000 saved up. It just depends on, like I said, where you are financially, but generally for athletes that have a contract, and just for expenses that are going to happen. So when I think of an emergency fund, let's think about the things that could happen. So you end up really ill and you need to meet the deductible on your health insurance. That's usually $2,000 or $3,000. I've had a client that got 4 flat tires. That was a real thing. And, that's a couple $1,000s, and not just like the ones you can put a little plug in. They had to get like 4 new tires, spur of the moment, no way you can plan for that. And it's expensive. Another thing I think about is like getting across country to family. So if you're one person and there's a family emergency and you need to get on a plane that same day, that's probably going to be $1,000 ticket. But you don't want to be kind of scrambling to figure out like how you're going to pay for that. You'd rather just have an emergency fund to do that. And if you're a family of 2 or 3 people, think about how much those plane tickets could cost. And then the other thing with the emergency fund is we usually say 3 to 6 months. 3 to 6 months comes from, it takes 3 months until disability kicks in. So if you were to become disabled for some reason, it would be 3 months before your long-term disability, if you have that kind of insurance, becomes available to you to tap into. So you would need to cover that first 3 months on your own. Now, as athletes, like you said, very seldom do we have the disability insurance. So we have to have the emergency fund. And if we were to become disabled, what does that look like? It's generally us getting injured. So disability for a normal person, is something where they're physically unable to do their work. And we can suffer from those things as well. But we are effectively disabled when we get an injury and we're not able to compete. And what does that look like? Imagine as a track and field athlete, for example, we're at the beginning of a season. It usually starts like March, April-ish. We're getting ready to head into the big time where we make money, and you sustain an injury at that point. So now, before you even got started, your season's over. That's no prize money for the whole year. If you have no contract, that hurts a lot. That's where you were just getting ready to start picking up your cash, and now there's no cash that's going to come in because. And then on top of that, now you've got to do physical therapy. You need to go see, the proper people. You might need to fly across, to Canada or to Germany to get additional help. This is why I say you need 6 to 12 months really of your emergency fund set aside. So it sounds like a lot of money, but when you think about the things that could happen, and when we've all just lived through COVID, or we are living through COVID, you realize how this could be a really great thing to have and just have cash sitting on the sideline. So the other thing that people first say is like, you want me, like, that's $120,000, Lauryn, or that's $60,000, or, whatever it is that is the amount that's appropriate for you. It's a lot of cash to have sitting around doing nothing, but its job is to do nothing. It's to kick into action when there's an emergency. And I know it feels painful. You're just like, I want to make my money work for me. I want to do this. This job of the emergency fund is to sit there and be ready to go, not to be, COVID happens and drops by 30%, and now you don't have it. So you do not invest your emergency fund. You let it sit, let it be where it is, and, have money above and beyond that is ideal so that you can do your investing, saving, and doing other things. So as we talk about investing, Tanisha said her favorite part is when I talk about how athletes retire twice. So we will retire from sport generally somewhere in our, mid 20s, early 30s, depending on what sport you compete in. Some people get to compete till they're 50, but in general, we don't. You get a 3 to 5 year window when you're at the peak of being able to participate in competing, and you need to save up for what's going to happen life after sport. So generally what happens is you're not going to be earning as much. If you're a high earning athlete now, elite athlete with a contract, you're not going to be earning as much initially when you get out of sport. So if you have a $250,000 contract right now, you finish sport and you want to go be a physical therapist, they generally make around 60 grand a year. So you've gone from, this really 5 years of high earning potential to, a job that you enjoy and you want to do, but $60,000 a year is not the same lifestyle. So what can you do to protect yourself against that? Build a lifestyle now that's going to be similar to the lifestyle that you're going to live later. Because we get, big house, big car, big, all these big things, big mortgage. That was a mistake I made. Big mortgage. I'm like, I'm going to pay this mortgage for the next 30 years when I don't have the same kind of income that I had when I purchased this home. So be thinking about, what am I going to have to do later, and what expenses am I going to be able to cover based on the income I have later, and build your lifestyle based on that. The other thing too is saving up what you have now so that you can have a nicer lifestyle later. So in that same $250,000 situation, if you decide to live off of $70,000 a year right now, and then you start making $60,000 later, well, you've lived a very conservative lifestyle while you were competing in sport. And you can continue to probably live that $70,000 lifestyle because you were banking, the difference between 250 and 70 all this time. So you got lots of money saved up to supplement your additional income. And now you can live a much better life during that time period where like, oh, I have additional income coming from this, but I'm only pulling 10,000 out of my investments every year to live a nice life. The other thing I always say too is think about, saving up some money for life after sport. So that first year when you're done, it's hard. You're going to be transitioning out. You're going to be mourning the loss of something that was really fun and cool and awesome in your life. You're not going to have, like I said, the income of it. And you're going to be trying to figure out what you want to do next. So what I do with my clients is we open up a brokerage account. And a brokerage account is a multi-purpose investment account. Multi-purpose in that it can be used for anything. You can take the money out at any time and you can invest it however you want. We put our money there for life after sport. So we're saving up specifically so that they have a year once sport is done to kind of figure it out. And some clients are saying they want 2 years, but it's kind of like a sabbatical. Like I have some time to sit down and think about it, maybe do an internship that's $12 an hour and not be mad about that. But I need some experience because I've been dedicating my full life to sport up to this point. So that's what the brokerage account kind of works for. And then you have the solo 401k and the SEP IRA. So once we get through, that first retirement as a sport from athlete, as an athlete from sport, then we got to think about retirement way down the road. We all have to do that someday. And like I said, as athletes, I think we're more prone to not thinking about that because we're focused on living in the moment. We're focused on, like you said, high level sports. We're putting in 110% effort and we're really healthy and young. So it's like, well, why do I need to worry about retirement? And we're not working at traditional employers where someone's asking like, hey, do you want to take out 4% every paycheck? So what do we need to do? We need to save for ourselves, and we don't want to get caught off guard. We don't want to be 30 finishing sport and not save $1 toward retirement, because now that money doesn't get an opportunity to work for us at all because it was 10 years we weren't contributing to retirement. So the solo 401k, you're going to need help managing, whereas a SEP IRA, you can set up on your own at a place like betterment.com or Vanguard. And then the maximum contribution to either of these accounts is $57,000 for a year. So what's really cool is that when you work at a traditional employer, you're going to be able to put only $19,500 away as an employee. But as an employer and an employee, you can put more money away. Now, they come with some sort of formulas, and like I said, Tanisha, that's where she works the magic in telling you how much you can put in based on how much you earn into the 401k or the SEP IRA. But the other really cool thing about this is that it saves you money on taxes. So it's going to lower your tax liability, which means you pay Uncle Sam less, and then you're putting money away for yourself for retirement. So you want to have either a SEP IRA or a solo 401k, especially if you're a higher earner that can save more than $6,000 a year. So if you're not in a situation where there's any, enough money left over that you can save $6,000 a year, then you're going to want to look over here to the right at the traditional IRA or the Roth IRA. So these are both easy to set up as well. Like I said, Betterment is the place I like. There's tons of different robo-advisors now where you can just get started online. I would avoid the apps, so Acorns and Robinhood and all the different kind of apps that exist. They have a lot of hidden fees that people don't realize, and they're just not as good at really. Like, you want to be on an investment platform. So Charles Schwab, TD Ameritrade, Vanguard, like I said, Betterment is one where you are on an actual investment platform, not so much an app. So these are easy to set up on your own, and the maximum contribution is $6,000. With the traditional IRA, you're going to save money on taxes. With the Roth IRA, you're not going to save money on taxes now. The Roth is super trendy for our age group because the Roth IRA allows you to put money away after taxes. And later on down the road, 20 or 30 years from now, when you want to take it out, you can take it out tax-free. So people who love the Roth IRA are betting on the fact that they're going to be in a higher tax bracket 20 or 30 years from now than they are currently in. Now, this is kind of like the great debate. I'm not going to pick a side today, but my priority more so is that you start putting money away somewhere. So if you're not saving, open one of these two accounts, get going. If you can save more than $6,000 a year, that's a big indication that you probably need additional help. And you need the solo 401k, the SEP IRA, and making sure that you're on track for retirement. And then don't forget about that brokerage account to save for life after sport. And so, yeah, as I kind of wrap up here, I think that if you're in a situation where, like you said, you have more money, you make more, you earn more than you spend, which is great. You have savings, you don't have a clear plan, and you need to kind of optimize all your situation, that you need both an accountant and a certified financial planner. So usually people think of like, oh, I need one, or I need somebody to help me with this thing. And generally the accountant is the winner because everybody knows that there's this thing called taxes that's due. And then the financial planning is that thing that's kind of like optional. And they're just like, they think of their financial plan. I mean, it's their accountant as their financial planner, but they're two different things. So the investing, the budgeting, the planning for the future, the setting up your goals and your values, that's what the financial planner is going to spend time on with you. Whereas the accountant is really going to focus on your tax strategy, making sure that Uncle Sam is paid in full, that you're not going to prison, and then also optimizing, giving you ability to make sure that you spend as little as possible with Uncle Sam while doing it all legally. So So yeah, as I wrap up, just a few words of wisdom. A lot of people like to put things on autopilot. I am a big proponent of automating your accounts, but not automating your life in such a way that you don't know what's going on. So when I say autopilot is cool, but learn to drive, you don't want to hand something over to someone in such a way that you have no idea what's going on. So if you're working with a financial planner right now and you know, like, oh, I don't know if I have a SEP IRA or a 401k, like you should know the basics. I always want to say I want my clients to be able to, you know, have drinks with their friends and be like, oh yeah, I got a solo 401k. That's for my long-term retirement. Yeah, and we're also saving in this brokerage account because I'm saving up for life after sport. I want you to have a kind of baseline idea of what your plan is and be able to communicate that. And we should be more comfortable communicating about money in general because we're clear on what our financial plan and our strategy is. The second thing is, like I said, plan for 2 retirement. So it is going to happen. One day you're not going to be able to compete in sport. And that's going to be one transition in and of itself. That's a big deal. And it has financial implications in addition to emotional ones. And then you're going to have old age retirement like everyone else. And then to give strategically. So when I say give strategically, a lot of times we think about like giving to nonprofit organizations or charitable causes that align with us. And early in our athlete lives, you know, you're kind of pulled all kinds of different directions. Like, hey, can you come speak to these kids? Hey, can you do this? Hey, can you do that? When I think of giving strategically, you can give your time when you don't have money to give, and you can give your time in a place where you can build a relationship. So we can do 10 different speaking engagements and never build a relationship with any of those things. Or you can really focus on like, oh, I really enjoyed this speaking engagement. I'm going to volunteer my time here. And I'm going to continue to save up. You know, maybe you do $50 a month or whatever you can afford to charitable, but you can give time, you can give talent, you can give treasure is kind of like the 3 T's people talk about. And when you're being strategic about it, maybe that becomes a place where the gentleman on the board of directors or the woman on the board of directors says, hey, you know, I really love the time that you gave to us during the time of your career. You know, maybe I can help you find a job. So you're building relationships when you give. You should give authentically, but also strategically. And then to find a mentor. So a mentor is not the same thing as the financial planner, the accountant, the agent, all these different people on your team. You want someone that you can ask questions of, that's not charging you anything, that wants what's in your best interest, that's just going to ask questions back to you to make sure you're doing, you know, you're kind of thinking through things. So I feel like a mentor is a very valuable person to have in your life because sometimes everyone has some sort of interest in line, and it's hard to understand like what's the best thing for me. You know, you might feel like you're being sold if you bump into an insurance salesman, as an example, and it may be trying to do the right thing for you. But if you have a mentor, you can say, hey, you know, this person said this, you know, how does this sound? What questions should I be asking? Even if the mentor is not an expert in that area, they're going to help you think through a list of questions and, you know, problems that could arise. It's better to have, you know, put 2 heads together than better to have 2 heads than one, basically. You guys know what I mean. And then last but not least, know what you know, but know also what you don't know. So, you know, we all have blind spots. We all have things that we don't know, or we don't know that we don't know. And that's why it's important to always be asking questions and not to, you know, feel ashamed or feel like we have to figure it out all on our own, which people do all the time with money. It's like, oh, I'm just going to keep working it out. I'm just, it's okay. Like, I got a roof over my head. I'm just going to, no. You know, there's some things that you're missing out on, some opportunities to optimize your finances. There's some opportunities, you know, just in life in general, when you don't know things and you're afraid to ask people or afraid to have discussions about it, then you kind of miss the boat, and that can end up being detrimental. So without further ado, I will hand it over to Tanisha, or do you want to wait and do questions, right? You're muted.
I know typically we wait until I do a presentation, do the Q&A. Do you still want to follow the same format, or do you want to?
I'm fine with that.
Okay.
Unless anybody has like a burning question that they feel like they can't wait, or yeah.
Anyone with questions for Lauryn?
You can also drop them in the chat and I can answer them while Tanisha's talking if you have questions like that.
I had one question about what Lauryn was talking about. It's Asia. Oh, let me turn on my camera. Hello. Hey.
Hey, girl. Hey.
Hey. Okay. But as you were talking about just like solo 401ks or SEP IRAs, is there like a certain starting point for that, or you can start from anywhere? Like, should you think about getting to a certain point in your career, or having a certain amount of money together first in order to start looking into those, or is it kind of like you can start from anywhere?
You can start from anywhere, but where I would say to start from is, like I said, so if we look at the 20%, let's say you make 100,000, you should be saving 20K. That's way more than 6,000. So you should probably have a SEP IRA or a solo sort of thing. If you're making, 60,000, 10% of that is 6,000. So you're like, oh, if I can save 10%, then I can keep going with my traditional or my Roth. But, if I'm going to do the 20%, if I can afford to do it, that's 12,000. I need a SEP IRA or a solo 401k. So at whatever point you can easily do 6,000 and you can do more, then you can go ahead and move over to the SEP or the solo.
Okay. Thank you.
So Alana asked about the difference between the SEP IRA and the traditional IRA. The SEP IRA is going to allow you to put more money away. The traditional IRA is going to be limited to $6,000 per year. So you can, if you made 100,000, you can put 6,000 in a traditional, and it takes you down to $94,000 for tax purposes. You're going to pay taxes based on 94,000. Whereas the SEP IRA, you could put, well, and it also depends on the amount of income. So there's a calculation that's like basically 25% of your income. So in that same $100,000 situation, like I said, Tanisha can get into the details of the formula and the calculation, but the general is 25%. So 100,000, you could put 25,000 away. So if you can actually afford to put 25,000, you don't want to be limited to putting 6,000 away. And like I said, it's up to 57,000 with the SEP IRA. The traditional just stops at 6,000, period. All right, it's all you, Tanisha.
All right, good questions. Okay, I'm going to share screen, our PowerPoint presentation. I'm just going to go through some, the topics I'm going to hit on today is just going to be really the most frequently asked questions that I get, especially from athletes. So hopefully you find some value in this. And you probably things that you're thinking of asking is probably going to be covered in here. If not, like I said, this is for you guys. So shoot me we'll have a Q&A session at the end here. Give me just a second while I get the presentation going. Okay. That's just a little bit about me. I've been, working with athletes since I retired back in 2000, I believe it's 2008. And we've been doing accounting, tax, financial reporting, payroll, things like that for not only athletes, but athletes who've retired from the sport, who've went on to start their own businesses. We have quite a few athletes that in that category, but we also work with other entrepreneurs and small business owners throughout San Diego and some in other states. And that's just a little bit about what we do as a firm. But what I want to go over is, one common pitfalls that I see with athletes, and we work with a couple of entertainers as well, but these are the things that I see over and over again as clients come to us for either tax planning, preparation, or just business development, financial reporting. We're going to talk about some common pitfalls that I see athletes and business owners making, or that they fall into. We're going to talk about maximizing your deductions. We're going to talk about athlete incorporation. Lauren gets this question a lot. I get this question a lot. Should I incorporate? And sometimes it's not for every athlete to incorporate themselves. Sometimes the athletes like the swag of incorporation, or they're here from their teammate or another person that they've incorporated, so they wonder if they should incorporate as well. And that's a very valid question, but it has to make sense for you to incorporate. We don't want to just tell an athlete to incorporate. It's a great fees for us, great revenue for us, but in good conscience, sometimes this just doesn't make sense for an athlete to incorporate, and we're going to talk a little bit about that in detail. And then another question we get all the time is, hey, I have an LLC, I have a corporation. Can I purchase a vehicle under my LLC or corporation? So we're going to talk about what that looks like. And then we're going to just go through some tips and resources, just some things you should look out for as a taxpayer when you're working with professionals to prepare your tax returns. Like Lauryn said, you should have a working knowledge of how things are working for you. If she does your financial plan, she's going to make sure you understand what she's doing. And that's the same thing. That's the same kind of model I work by when I'm working with clients on their tax preparation or tax planning. Okay, let's talk about common pitfalls. The number one pitfall I see is just pure procrastination. Sometimes just clients in general, they may procrastinate and get their tax returns filed because they owe or they haven't filed their taxes in a number of years. And so they're afraid of, what the outcome is, or afraid that the IRS is gonna come get them. But I will tell you, the IRS will come get you if you don't get the taxes done. However, 99% of the cases that I have where I've filed back taxes for as many as 6 or 7 years for some clients. And 99% of those cases, the fear is always greater than the reality. So I would say, don't procrastinate. Let's get you in compliance. If you have any concerns in that area, you can have a confidential, call with me or anyone on my team. We can get you in compliance, but don't procrastinate. Same thing with getting your finances in order or paying your taxes. Procrastination is always more expensive than being proactive in this area. So I just encourage people to really plan and seek help, seek guidance. I know Lauryn has an open door. I have an open door. We're happy to help. And our passion is really helping with athletes because we were athletes before. Sometimes we didn't have the resources. So we want to be a resource for athletes. The second common pitfall I see with athletes or just the clients in general is just very poor record keeping. And this could be due to just lack of knowledge, or they have the knowledge, but again, they procrastinate. And so they don't keep good records of their deductions. So when you're taking deductions on a tax return, the IRS wants you to keep good records of the reasons behind those deductions or to substantiate those deductions. Let's say you go to Office Depot and buy some office supplies. You need to retain that receipt so that if your tax return gets called into question under an audit, a correspondence audit, or even a field audit, you can support that deduction you've taken on the tax return with the actual physical receipt. So one of the things I harp on is proper record keeping, especially if you are an LLC or a corporation. Record keeping is mandatory by the IRS, okay? The other thing is not budgeting. Lauryn talked about budgeting, not budgeting for taxes, not budgeting for, Uncle Sam, one way or the other is gonna get his money, gonna get his due share. So I've had a couple of clients who would just not pay their taxes and not pay their quarterly estimated taxes. So when April 15th comes around, they have this big tax bill and they want to know, what can I do to minimize my taxes? Well, April 15th, it's really too late to plan at that point. We have to stay connected. You have to stay connected to your tax preparer, whoever that may be, or your financial planner, whoever that may be, to properly plan and so that you don't have a big cash outflow come April 15th. But when you don't budget for taxes, then you're scrambling, trying to reallocate funds for necessary spending to pay for your tax bill. And sometimes, people just fall short of that because mostly for lack of planning, just lack of knowledge, knowing that they need to send in quarterly estimated taxes. And this is particularly important with athletes because, we don't have taxes taken out of our earnings. If you get prize monies from overseas, or if you're under contract, you usually just get a quarterly payment and taxes are not withheld. So you're responsible for making those estimated tax payments. So it's very important that you do those quarterly. If you don't do it quarterly, at least save it so that you'll have the money come April 15th, okay? So not paying quarterly estimated taxes, not budgeting for taxes, not setting aside money for taxes, those are two very common pitfalls. And then no money team. When I say money team, athletes, we have coaches, we have massage therapists, we have rehab therapists, we have all these people on our team to help us achieve athletic excellence, right? But on the financial team, there's no team there, or maybe one member, or it could be your mom doing your books. Sometimes it's not sufficient. Sometimes you have to graduate and get to the level where you are athletically. And if you have a contract, you need to upgrade your money team. And that needs to be a licensed professional, whoever that may be. It may not be Lauryn, it may not be me, but you need to have a money team to help you manage your finances so to make sure you're keeping proper records of your deductions, that you are budgeting for taxes, and that you are planning for, like Lauryn said, your two retirements, retirement from the sport and then retirement when you get up there. So when I sometimes when I come into contact with clients, sometimes they've been given wrong information, or they didn't fully understand the information they were given because they were not working regularly with a finance professional, whether it be a CPA or a financial planner. And number 6 is kind of a piggyback off of number 5. When you don't have a money team, you want to make sure you have a good working knowledge of how your money is working, where your money is going, how are you paying taxes. When I work with clients, we especially first-time clients, we go through their tax return line item by line item, schedule, just about every schedule, because it's important for them to know, it's important for clients to know, hey, are we reporting properly your income, the total income that you earned? Are we missing any income? Or are we over-reporting income? We want to make sure any income being reported on your tax return is taxable income that should be reported on your tax return. And then we go through their deductions, and we let them see how their deductions reduce their taxable income. And then most importantly, on the second page of the 1040, we want them to see what their tax bill is or what their refund is. Because if your tax refund per your tax return says you're getting a refund of $5,000, but you only see $3,300 deposited into your bank account from the IRS or from the Treasury Department, then something's off there. So we do these checks and balances, review the tax returns with the client so they will know what to expect if they're getting a refund, and then making sure reconciling with the tax bill or the liability per the tax return. The tax return shows that you owe $10,000, and you tell your accountant or your CPA that you want that $10,000 auto deducted from your checking account. You better make sure that $10,000, you see a draft from the IRS being deducted from your checking account. If you see $7,000 being deducted from your checking account, you might want to investigate that. That means somebody ran off with $3,000, and that has happened. I've had a client where that has happened. In this particular case, the client, he was a contracted athlete making great money. He trusted his financial advisor to make all his tax payments. Guess what? He or she was not making those payments. And guess what? Years later, he found out he had 6 figures due in taxes. So we want to make sure you have a working knowledge. You make sure that your taxes are getting paid. That's by double checking your bank account and making sure that you see a deduction or a draft from the Department of Treasury, from the IRS, and not from Joe Blow CPA. And then the other pitfall I see is just no oversight. You want to have checks and balances in place where you know what's going on. Like Lauryn said, you want to know where your money is going. So you want to make sure that the plans you set up, you still have access to all your bank accounts, your business bank accounts, personal bank accounts. You're not just turning over everything to a financial planner or even to a CPA. We have a fiduciary duty, of course, to, we have ethical commitments and that we can't, of course, steal from clients. But as you know, there's been Ponzi schemes. There have been CPAs who've been, and financial planners who have been, reprimanded or arrested or whatever, or lost their license because they've stolen money from clients. And that's because clients do not have any oversight or checks and balances in place. So you want to make sure, and that's where a good mentor will come in as well. Now, maximizing deductions. Now, when we're talking about deductions, the only thing you need to realize, sometimes clients are asking me, hey, I don't know if this is deductible or not. I don't know if I should include it, should I include it? And the general rule of thumb you want to keep in mind regarding deductions is that the IRS only has 2 requirements for deducting business expense. The expense must be ordinary and it must be necessary. It must be ordinary in the sense that it is a ordinary expense in your trade or business. So for track and field, some ordinary expenses are what? Gear and equipment, massage therapy, rehab, sports care. And it also must be necessary, meaning it's necessary to carry on your trade or business so that you can operate or produce a profit. So that is really the only requirement the IRS has as far as deductibility of expenses. It has to be ordinary and then it has to be necessary. I usually tell my clients when they're preparing their tax documents to send to us for tax prep, that if you're unsure about an expense, always include it with your tax organizer or your documentation, and then just outline what that expense is, and we'll let you know if that expense is deductible or not. Don't omit it thinking, oh, I'm not sure if this is deductible, so I'll just leave it. No, that's our job to determine if that expense is deductible. I'd rather you to include it and take it, and so that we can be informed, so that we can take deduction for you if it's allowable, rather than you not include it and it ends up being an allowable expense that you can deduct and you don't get it. Okay. Maximizing deduction. Now, this is just a list of common deductions specifically for track and field athletes, but this is common for just about any athlete. You have travel. Travel is deductible. Travel to sporting venues, to track meets, to third party or to third training sites or second training sites. Sometimes, especially for distance athletes, they may go to Mammoth Lakes or some other high altitude training to train there for 3 months or 2 months. You can deduct travel and lodging and transportation related to training competition expenses. Now, this list and this first two columns here for common deductions is not by any means exhaustive. These are just give you some ideas of what are deductible expenses. You have gym fees, you have uniform gear and equipment. Uniform gear and equipment includes equipment bags, spike bags, shoes, poles for pole vaulters. All those items are deductible. These are all ordinary expenses and necessary expenses for track and field for your sport. So these are common deductions. You want to maximize these by taking these deductions. And then these deductions, this list, will probably jar your memory of some of the other expenses you've had throughout the year that you didn't know or that you should include when you're preparing your tax prep package to send to us. Now, what I do want to talk about is some mistaken deductions. Sometimes athletes or even personal trainers, we have personal trainers or coaches, they want to know if they can deduct their groceries, because I had one personal trainer says, oh, I got to keep my body fit. So it's important that I stay fit so my clients, I can get more clients. And when I'm training clients, they can be inspired and they have confidence that I know what I'm doing because I'm fit. And so therefore I should be able to deduct my groceries. That's all cute and everything to think that you can deduct your groceries, but it's not allowable. You have to think, I tell clients that you have to think in terms of the IRS. The IRS is only going to give you so much lee room. They're trying to collect as much taxes as possible to generate as much revenue as possible to fund our schools and government programs and things like that. So if the IRS allowed every taxpayer in the athletic world or fitness world to deduct groceries, that's gonna be significant. So groceries are not deductible in that regard, and also because groceries are something you eat, you consume every day as a normal part of life. If it's not specifically for a business purpose, that's not going to be deductible. Okay, now if you're out of town at a training site or a track meet, and you buy groceries for your hotel room, that would be considered meals or things like that. That would be deductible. But just everyday groceries for consumption at home, that is not deductible. And then travel for family. Sometimes athletes will pay for travel for their family to travel to the Olympic Games or World Championships or to some meets. If they're not performing a job for you, if they're not hired help, that's not deductible. If I have an athlete whose husband trains her, so of course, he travels with her to track meets or things like that. Well, he's already her coach, so yeah, that travel would be deductible. Those expenses would be deductible. But that's just to have your brother or sister come watch you and support you at the Olympic Games. Unfortunately, that would not be deductible. Now, we talk about sports gear. I said uniform gear and equipment is deductible, but if you have sports gear that can be used for everyday wear, like your tennis shoes, Nike flat tennis shoes that you can wear to the grocery store, you can wear, to on a date or to a restaurant. That type of gear is generally not deductible because it's used for everyday wear. Now, if you had, let's say you had a Nike polo shirt that had a business logo on there, like let's say Sheffield Elite Track Club. That would be a deductible item if you pay for something like that, or it had your business, your LLC name on the shirt. That would be considered uniform, and that would be deductible. If it's something that you can wear every day, that would not be a deductible expense. Now, entertainment expense, meals and entertainment expenses, you used to get a 50% deduction for meals and entertainment, but with the 2018 new tax laws, entertainment expenses only were eliminated. So entertainment expenses like going to the movies when you're over in Europe, or buying music, or downloading movies, or your Netflix subscription, those used to be deductible items for, before the 2018 tax laws. They're no longer deductible items. So now you'll see in our tax prep packages that we have a separate line item for meals, then a separate line item for entertainment. So to make sure that we don't unintentionally deduct entertainment expense. Now, hairstylists, barbers, manicures, and pedicures. Now, these expenses we get questions about too. Are they deductible? Generally, they're not deductible. If you go to, say you have a track meet on Saturday, that's on television, and you decide to go Friday to get your hair done, are you able to write off that expense? No, because that's a type of expense that you can generally enjoy every day and everyday wear. Okay. Now, if you're modeling something for Nike, if you're doing a Nike commercial campaign and you have to get your hair done or get manicures, pedicures, things like that, that's different. That's why we have an asterisk there. That is different, and that will be a deductible expense, because you are incurring expense for something like a model or photo shoot like that. That would be an exception. So hairstylist, barber, manicure, pedicures, those are deductible expenses. Those are exceptional deductible expenses. So it's really a judgment call, and depends on the circumstance. The other mistaken deduction, and this is an important one, is a home office deduction. Now, home office, you can deduct you can take a deduction for the business use of your home office. The caveat is that the home office the area for the home office has to be exclusively used for the office. In other words, it can't be your living room where you use part as living room or part as the home office. It has to be an area exclusively for a home office. Now, if you have a big living room area, and let's say your living room area is 600 square feet, that's a huge living space, and you use 300 square feet exclusively as a home office, then you can only deduct 300 square feet. I mean, you can use the 300 square feet for the home office deduction. You can't use the whole 600 square feet. But where clients misunderstood in this area is that they may use part of the bedroom as a home office and part as where they sleep, and the IRS comes back and says, no, that is not allowable. Okay. Now, substantiating your deductions. This is where I probably nag clients the most. When you take a deduction on your tax return, you're effectively reducing your taxable income, meaning you're going to be paying less taxes. So, the IRS really hone in on the deduction part of the tax return. So especially with Schedule C filers, that means Schedule C filers are self-employed filers. If you're unincorporated and you have a business, you're self-employed, you file your business income and expense on the Schedule C. And the Schedule C is one of the most audited portions of a tax return. And some of the most audited areas are travel, meals, entertainment, now meals, since entertainment expenses are no longer deductible. Travel and entertainment expenses are the most scrutinized areas of the tax returns, because sometimes a client or a taxpayer in general would say, hey, I earned $20,000 in gross receipts, but I had $15,000 in travel expenses or meals and entertainment expenses. And that right there will raise a red flag. And we're not saying that that's not an allowable deduction. You just better have some receipts and documentation to show that you actually paid $15,000 in travel or entertainment or meals expense. That's the thing. You want to keep meticulous records of all your deductions, all your expenses. And
Tanisha,
yeah.
I just wanted to jump in here too, because this is something that, a lot of people are trying to pay as little as humanly possible toward taxes and write off everything. And I saw quite a few clients kind of get bit by this. So some people are LLCs, it's sole proprietors, independent contractors, things like that. who are not on payroll, like many of me and Tanisha's clients are. And what they did was write everything off, and what they used for PPP. So that was a big thing that came out this year to help people during COVID. And a lot of people weren't eligible for PPP because as per their tax return, the way that they were doing the calculation, they had no income. So at the time that they most needed help, they had been writing every single thing off, and it looked like you had no profit. So therefore there was no PPP for you to get. So to be mindful of, trying to cheat Uncle Sam, and now, it kind of backfires on you.
Yeah, absolutely. And that was that was a really unfortunate part, or the flaw with the PPP loan for self-employed people, because you had to basically show you're profitable to get a PPP loan, because it was based on 2.5 times your net income, I believe, on your Schedule C. But then, and unfortunately, I mean, it did bite our clients on the butt in this area, and this is really one of the reasons why we do harp on make sure you have an emergency funds, emergency savings. Yeah, it's okay to be aggressive on your tax return with your deduction so you can pay less taxes, but you also need to, make sure you have savings, in case of a crisis, as the COVID crisis. And then the other thing too is just, keep your actual receipts. It's not enough to just present a credit card or bank statement. That would not uphold in the audit. I remember about 7 years ago, I represented a client in the IRS audit. He was a traveling nurse, and he had not one for the $25,000 deduction she took on his Schedule C. Not one. He may have had, when I say not one, I'm exaggerating. I would probably say of the $25,000, he could show receipts for $1,500 of deductions, and there was just no way to win that audit. He just kept all his credit card and bank statements, and the IRS would say, "Look, you know what? I see that you went to a uniform store for nurses, whatever the store is, medical uniform, and spent $200 worth of uniforms, or spent $200 at the store, but it doesn't show what you spent on, what the item is." So the deduction was disallowed. And where I was able to save the client somewhat is, hey, I tell the agent, hey, he's a nurse. It's proven that he's a traveling nurse. Of course, he's had to pay for some uniforms, some nursing shoes, some expenses. So let's look at let's at least give him some general deductions, some standard deductions. Even if he can't take the full deductions, actual expenses, let's give him something, because that the taxpayer incurs some expenses while as a traveling nurse. But it was a hard lesson for this client, because he thought, I'll just keep my credit card and bank statements, and that's a no-no. You need to have actual documented receipts. Okay, I cannot stress that part enough. Okay, let's get to this part. And I think, some of you guys are probably already set up. I know 3 or 4 of you guys are already set up as LLCs or corporations. The thing I get a lot of questions from athletes, when should I incorporate? Should I incorporate? What's the benefits of incorporating? And some athletes like the swag of just saying, hey, I have a corporation, I have an LLC, and I'm paying myself through the LLC. But is it really saving you money to have an LLC? Is it really saving you money to have a corporation? It may or may not, and you may be incurring more costs to have the LLC, to operate it, to keep it open, to fulfill the filing requirements of the LLC, to pay taxes, and us to file your tax returns than it is to actually benefit from it. And we don't want to see a client do that. And I don't like to waste money. I don't want clients to waste money. So first, when the client asks me if they should incorporate, I tell them, let's understand the cost. Let's run the numbers. Will the cost outweigh the benefit of having a corporation? And we really need to understand that. What are all the costs entailed with having a corporation? And then the other thing is to understand the responsibilities of having a corporation. I know clients who want the benefits of the corporation, but does not want the responsibilities. They don't want to pay corporate taxes. They don't want to pay the accountant to file the tax returns. They don't want to do the annual reporting. They'd rather us do it, but then they don't want to pay the annual reporting fee. It's just like, then why have the LLC? There's a big responsibility that comes with having a corporation, both for you as the client and then for us as your CPA, okay? Some of the costs are the entity setup fees. That's the Secretary of State filing fees, the payroll setup costs, because now if you're an S Corp, you have to take a reasonable salary from your S Corp. So you got to think about the payroll costs associated with that. There's monthly processing fees for running your payroll. Then there's payroll taxes as the employer. Then there's the business taxes, income tax at the state level. And then there's taxes, there's no taxes at the federal level if you're set up as an S corp, but sometimes in some states, there's gross receipts taxes when you have a corporation that you have to pay taxes on. And then there's Lauryn, you have her doing your business budget or planning. And then there's us who have to do your corporate taxes and then run your payroll, and then working with your payroll processor to make sure your payroll is run correctly. Or if you get a payroll notice, then we're working with the payroll processor to make sure, to see if the notice is legit, or if there's taxes that might have been missed. I mean, these are all very real scenarios when you set up a corporation, and a cost that must be considered. And if all these costs do not outweigh the benefit of having a corporation, and that benefit is to pay less taxes, or if it just saves you a little bit of money in paying taxes, I'm going to say do not incorporate. I mean, in good conscience, I mean, I can't say incorporate. Now, if you're persistent and want to incorporate because you just want the swag of incorporation, I mean, that's your business. But you know, now, especially now with the QBI deduction, you probably don't need to incorporate. And depending on what type of contract you have or what your income levels are, you may not need to incorporate now that we have the QBI deduction. And we're going to talk just a tiny bit about that. And then responsibilities of incorporating. Did you know when you incorporate, you have to do annual filing with the Secretary of State? We do this for our clients. Our clients, most of our clients don't even know that we do this for them. We have it set up on a scheduler to just submit the reporting to the Secretary of State, whether it's Texas or California or New Jersey or Rhode Island or Oregon. We just file this on behalf of our clients. And then, like I said, there's tax filing, there's payroll tax returns to be filed, there's income tax returns to be filed, and then the record keeping. Some of our corp clients, we do the bookkeeping for them. We set them up on QuickBooks and connect their bank or credit card account so we can do quarterly bookkeeping for them. That way, at the end of the year, when it's time to do tax returns, guess what? They don't even have to fill out a tax organizer because we have all their expenses. We already have the balance sheet. We already have the income statement because we've been doing their books throughout the year. And it's just a matter of running those reports. And then if you have a balance sheet reporting requirement with the IRS, we already have that information to submit with the tax return. So that saves less money and time at the end of the year. If you have someone doing the bookkeeping. But if you don't have a record keeper, could be just, you keep an Excel, you can keep an Excel spreadsheet of all your expenses, but just make sure you have your receipts, okay? But understand the cost. Typically I'll run numbers with clients saying, okay, if you made $100,000, and you have these expenses. So the entity setup fees are one-time expenses, but the ongoing costs like payroll costs and taxes and professional fees, the fees you pay us to prepare your corp tax, that's that's tax prep fees for business in addition to your personal tax prep fees. So we want to make sure that all these costs outweigh the taxes you would save to incorporate. Okay, so there's not really a blanket answer. I always say let's run the numbers, let's do the analysis, see if it makes sense. If it's going to save you significant money, like several $1,000s, then yeah. If it's going to save you like $1,000 or $500, I mean, money saved is money in the pocket. I'll leave that up to the client. But sometimes having a corporation and completing or staying in compliance with having a corporation, both the federal and state level, can sometimes be more of a headache than it's worth. And that's why I say we absolutely have to run the numbers, okay? And then also, if you're working with a financial planner, you got to talk to your financial planner about all these costs too, to see if it makes sense in your budget. Does it encroach upon your ability to save for taxes or your retirement? Do you have enough free money to incur all these additional costs? So you really have to run the numbers and make sure it makes sense. All right, vehicle purchases. I get this a lot. This is probably one of my favorite things. I guess one of my favorite things to talk to athletes about. This is probably one of the misunderstood deductions or information that athletes or just clients in general get. I had a client who has her own medical practice, and she thought incorporating means she could write off her personal rent expense, her personal car expense. I heard, I can just write off all of my living expenses under a corporation. And yeah, you can do that. But all those expenses will become taxable to you because that's a fringe benefit. So you end up paying taxes on that, double taxes as an employee for fringe benefits, because you got to include that as part of your W-2. And then as an employer, you're paying employment taxes and all that stuff. Let's say, some corporations, they have these corporate housing that they put their employees in. That housing, the cost of living or the fair market value of staying in that house would be a fringe benefit to you. So you have to pay taxes on that, okay? One of the common questions I get is, should I purchase a vehicle under my business name, under my LLC, or under my personal? In all, it really doesn't matter. I mean, you don't get any more tax advantage by having the vehicle purchased under your business name versus your personal name in general, meaning you have to meet the same criteria whether you purchase the vehicle under your business name or personal name. So let's start with the business name. The IRS requires that if you purchase a vehicle for corporate use under the corp name, you have to expect to use that vehicle regularly for business. It can't just be a vehicle you buy for under your business name and then you use it only for personal, okay? That is not allowable, okay? And then there's a mileage test you have to meet, and that mileage test is that vehicle has to be driven at least 10,000 miles per year during the year or the time that you own it to meet the mileage test, to meet the business use test, okay? All right, and then if the vehicle is purchased under your business name, it has to be used primarily by employees, okay? And used by employees for business use, okay? Now, if an employee uses a business vehicle for personal use, then that becomes a fringe benefit to the employee, and that fringe benefit, the value of that fringe benefit must be included in the employee's W-2 as taxable wages. Now you have the employee paying wages on that personal use of the vehicle, and you have the employer paying employment taxes on those wages because that gets included in the wages. The best way to circumvent that is for the employee. If the employee is using a business vehicle for personal use, the best way is for the employee to reimburse the company for the personal use, okay? Now, the other caveat with that is that if you buy the vehicle under your business name, and you will have to register that vehicle with your state DMV under your business name, the DMV is going to classify that vehicle as a commercial vehicle. And guess what that means? Commercial vehicle can be equated with higher insurance rates, okay? So you want to just make sure that it makes sense, that you use it for, you purchase under your business name. If it's used mostly for business, then you can do that and pay the, if you get it financed, you'd be paying the note out of business funds. But guess what? That car note or that auto note is not a dollar for dollar deduction because you're paying on a note. That's a liability. The interest portion of that car note would be deductible on your tax return, okay, on the business tax return, but not the entire car note itself. So that's one of the things that gets misunderstood with clients. They think that the entire car note would be tax deductible, and that's where they think there is the benefit of purchasing a vehicle under the business name, and it doesn't work that way. Now, if you purchase a vehicle on your personal name and use it primarily for business, that is absolutely 100% okay. So let's say you purchase a Toyota Camry for businesses, but you get it under your personal name because most of the times you have not accumulated enough business credit to get it under your business name anyway. So car dealers will want you to be a co-signer or the guarantor of the loan. So let's say you purchase a vehicle, a Camry, under your personal name and you use it 6% of the time for business use. What you would do is just get reimbursed by the corporation or your LLC for the business usage of that. That would be a much more efficient way because now you're not paying employment taxes on that. It's not being included as part of your W-2 wages, not having to pay employment taxes for that use. And it still becomes a deduction for the business because it's reimbursing the employee for travel auto expense, okay? Now, when we talk about regular business use, the IRS determines or qualifies regular business use of a vehicle in that it is either A, the vehicle is used at least 50% of the time, at least 50% of the total mileage is used for business, okay? or the employer, the business is sponsoring a commuting vehicle for employees on a daily basis to get to and from work. I used to work at this company in Orange County where some employees would work or live an hour or 45 minutes away. And so they would take a train in into the city, and the company will have a commuting van, a 7-passenger van at the train station waiting to pick up the employee to take them to work. That is a deduction, and that is considered regular business use for the employer, and they would get a deduction for that vehicle. Okay, so to qualify as a business vehicle, it has to be used at least 50% of the time, or 50% of the total mileage used for the vehicle has to be used for business, or it could be a vehicle used for daily commuting employees. And it has to be a minimum of 3 employees. So it can't just be yourself. So if you're commuting to work, it has to be a minimum of 3 employees used or taking use of that vehicle. Now, the mileage test I talked about before, the mileage test, it has to meet the mileage test where the vehicle is driven at least 10,000 miles during the year, okay? And the vehicle is used primarily by employees for business use, okay? Now let's talk about some tips and resources. Always, whether you're incorporated as an athlete or not, have a separate checking account or a debit or credit card for your training and competition expenses. This is crucial because with our sport, you know, there's ebbs and flows in our sport. You know, we all know that Olympic year, World Championship year are the year where we can really earn high income, high revenue, because there's more meets. You know, companies get into Olympic year and they're liable to sponsor more athletes, and then prize monies are greater in those years as well. So in the Olympic year or World Championship year, you may be earning, you know, 6 figures or, you know, during the year, okay? And then the next year is a dead year, or you get injured the next year and then you're earning 0, right? But then you still have all the expenses because you still got to rehab, you know, you're doing a very light training depending on the extent of your injury. So you may have more expenses than you do injuries. So on your tax return, you may show a profit one year and then a loss another year, and then profit, then loss, and then more loss, depending, you know, just the season. You may be healthy, but have just a crappy season. So given that, the IRS may look at your 5 years of your return, especially if you're a Schedule C filer, particularly if you're a Schedule C filer, and see that in 3 of the 5 years, you've been operating at a loss. And in that case, the IRS may inquire with you, or, you know, may have a correspondence audit, you know, may see the correspondence audit, because they're trying to determine if you're really a business or if you're just a hobby. And usually if you're operating at a loss in 3 of the 5 years, it doesn't have to be 3 consecutive years, but if 3 in the 5 years that if you've had losses, the IRS may recharacterize your business as a hobby. And one of the things that you can show that you're actually in, your intent is profit motive, is you keep a separate account, checking account for all your business expenses versus your personal. Don't commingle, keep a separate checking account. There's some other things we have to show that we have profit motive intent, so that we're not recharacterized as a hobby, but this is a main thing. Maintain a separate checking account. You can go get a separate personal account, and that can just be your account that you use for track and field, and have another personal account for all your, you know, your living expenses, but maintain a separate account and have only your training competition expenses funded from that account, okay? And have likewise have all your training or your competition income coming into the account, okay? Just sport income coming into that account. Then retain business receipts, and then download apps to help you manage your books or receipts or auto track your mileage. There's free apps out there. There's QuickBooks. There's Wave. Wave is a free accounting app that's been becoming more and more popular these days. HubDoc and Receipt Bank, those are apps where you can scan in your receipts. You can also, most businesses, like I know Staples, like office expenses, like for Staples, Office Depot, you can have your receipts emailed to an email address, and then you have electronic copy of your receipt that you can just save in your email box, you know, forever. I would suggest even that'll save you some money on, you know, some of the apps that may cost a few dollars a month, or some that may be a bit more expensive than that. but wherever you can, just request electronic receipt wherever you can. A lot of doctor's offices do that now. They can send you a billing summary statement. That's sufficient. But main thing is you want to do whatever is possible, or use whatever tools are possible so that you can manage your books and track your mileage and manage your receipts. Now, per diem rates, when athletes travel, whether they travel domestically or internationally, you can use, instead of using your actual expenses per your receipts, you can use the per diem rates given by GSA, and I have the website links here. The per diem rates, they're allocated by the Department of State for your meals, incidental expenses, and lodging. Now, if you decide to go with the government per diem rates for the deduction for your time that you're actually in that country or your city, you still have to keep your actual business receipts, because the receipts substantiate your presence in that city or that state or that country, okay? The per diem rates usually give taxpayers the higher deduction for meals and incidentals and lodging than their actual receipts, but you absolutely have to retain your actual receipts to substantiate your presence there, okay? Now, this is what's concerning to me. Every year, I swear, it works like clockwork. Mid-January, early February, I get clients emailing me or calling me and saying, I got this calling, or someone called me from an 800 number saying that I need to call them and I need to send them a green dot card or a Google Play card. I know this seems ludicrous, but especially with older taxpayers, retired taxpayers, they sometimes fall victim to these scams. There's always scams out there. There's been already COVID relief funding scams out there that SBA and the Congress is trying to get on top of. Some things I tell my clients is always, the IRS will always contact you via mail first. They will never just cold dial you or cold call you, okay? So if you get a call from somebody saying they represent, an IRS agent, run it by me first, or run it by Lauren. She's very savvy and sophisticated in that area as well. Always check with your a trusted advisor before you even return the call. Okay, I had a clients even send me their voicemails that they receive, and I always tell them, hey, that's just a scam. Okay, so be careful of that. Never send money to anyone claiming to be an IRS agent. That is just not how the IRS works. An IRS representative or agent will not tell you to wire them money or send them to Western Union or go get a prepaid card. You pay through irs.gov. You want to pay your tax balance, you mail a check to the Department of Treasury. You can go to the IRS website for a list of payment address, depending on where you're located. There's address where you can mail in your tax payments, and then there's trusted websites where you can make your tax payments. Never, never, ever, ever allow anyone to prepare your tax return and charge you a fee based on how much a refund they can get for you, okay? Man, I had a client get so jammed up with that. There was a guy at his job that was preparing a lot of his coworkers' tax returns. First of all, the guy would have all of them send their W-2 tax statements to a PO box. Okay, he never met the employees in person. All their tax documents went to a PO box, and he said, "Hey, if I can get you $10,000 back in refund, I want 30% or I want 40%." That should be a red flag right there. Okay, because no preparer can guarantee that you're going to get a certain amount of refund back. It's all contingent upon the tax documents you prepare, taxes you have withheld from your pay, or estimated tax payments you sent in, okay? And then also it would just incentivize the preparer to do something fraudulent, to prepare a fraudulent return in order to get you a refund that he's promising you. And that's exactly what's happened with a couple of clients I've worked with that came to us. And the reason why they got caught is that, the reason why they realized that something was wrong is when the IRS sent them an audit letter saying they're going to audit. The fraudulent tax preparer created charitable deductions that they just didn't have. Let's say, for instance, a client made $100,000 in 1 year. The tax preparer showed on Schedule A that they contributed $40,000 to a charitable contribution, and then they had a Schedule C with a $40,000 loss. And it was just really some outrageous reporting on the tax return. So never ever allow anyone to prepare a tax return and they charge you based on how much they can get back for you. Okay. Now there's some legal recovery-based engagements that are allowed by the IRS, but just in general, if just run from them, okay? And then you want to literally run from a tax preparer whom you paid to prepare your tax return and they refuse to sign your tax return, okay? We are obligated, we are mandated by the IRS. If we get paid to prepare your tax return, we have to sign the return. I, as a preparer, as a CPA, have to sign the tax return. If you come across anyone who doesn't want to sign your tax return and you pay them, run for the hills, okay? Another thing, you want to, if you haven't already, you want to obtain an EIN number, okay? If you're not incorporated, I would not give out my social security number when you fill out W-9 forms. I know that with USA Track and Field and USOC now, they are requiring that. That's fine. That's a legitimate organization, but wherever you can, use an EIN number, okay, for further protection. Okay, so most frequently asked questions, sometimes, before I said some of the common pitfalls I see with clients before they come to us, when they come to us, is that, they procrastinate. And a lot of times the procrastination is a result out of fear, especially if they haven't filed their taxes in 1 or more years, or if they can't file their tax source documents. It just becomes an overwhelming task, a daunting task. But guess what? There are solutions for all of that. We have an account with the IRS where we can obtain, W-2s and 1099 forms and tax account transcripts from the IRS for clients so that we can prepare the tax returns. Just to keep in mind that whatever you get in tax reporting form documents, the IRS also has a copy. So even if you don't have a copy, we can get you to sign a POA or power of attorney form to send to us to sign so that we can obtain those documents for you. We can obtain them by fax or through our TDS system that we have, account that we have with IRS. So don't let that steer you or deter you from, getting compliance, okay? And then another, we get clients saying, I know I'll probably owe tax. I haven't filed in 8 years or 6 years or 3 years, but I know I'm probably gonna have a tax bill. That's why I haven't wanted to file my taxes. So what? You get a tax bill. Guess what? The IRS, if you take the initiative and get in tax applying and file your back taxes, we can work with the IRS to get you on an affordable payment plan. So there's solutions, there's solutions for all this stuff. Don't let that deter you from getting in compliance, okay? If you owe taxes, you're gonna have to pay whether you file your tax return or not. And I would encourage you to file, because when you don't file your tax returns, the statute of limitations is wide open, okay? Typically, the IRS has 10 years to collect on taxes, but if you don't, and the 10 years from the date that the tax is assessed, okay? If you don't file your tax returns, guess what? That 10 years don't start until you actually get the return on file and the tax is assessed, okay? So you wanna toll the statute by getting your tax returns filed. So don't let procrastination, don't let fear. We're here to assuage those fears. We know the law, we know the IRS law, we know how to operate. We can get you in compliance. That's all I have. Of course, you can contact us. This is our team. Tico's new to our team. We're going to do some new photos to add him to our team, and Craig as well. But you can always contact us if you have any questions. We're always available. That is all I have. I guess now we can open up the floor for Q&A for anyone who has any questions for anything that we haven't covered already. And Lauren, feel free if you want to piggyback off anything that I said or add to anything that I said there.
Nope, nailed it.
So I have a question about HSA.
HSA?
Health saving accounts. I just pulled over, so I can talk now.
Mm-hmm.
Yeah, can you talk a little bit about that?
I'll talk about it, I guess, first, and then Tanisha, if you want to add something. So yeah, health savings accounts are really good options for you to be able to put additional money aside for healthcare expenses. You can do $2,500. I think the amount is going up, or $3,500 or $7,000 if you're a family. So $3,500 as an individual. And the cool thing about HSA is it's something else that's going to help lower your tax liability. So if you put the full $3,500, that's $3,500 that you made less on paper. so less money that you pay in taxes. The thing to be considerate of when you think about health savings accounts is, one, you have to have high deductible health insurance. So that means you're going to have a higher deductible should something happen. If you're young, healthy, don't go to the doctor a whole lot, that could be great. But if you have that high deductible and you're, going to the doctor constantly, you're gonna have a lot more out-of-pocket expenses. And that's the thing that you kind of gotta weigh, is like, is it worth this tax savings when I know I'm paying a lot more out of pocket? And what does my budget look like to be able to do that? Now, on the other hand, sometimes you have people that have a lot of money and they're just like, oh, I can meet the deductible either way. Like, I have a lot of health expenses, but it's still, I'd rather pay the health expenses and be tax-free than to, not have them at all. The other thing is that's cool about the HSA is, like you said, if you're really healthy, you do the $3,500 every year. Let's say you use, only 500 of it, that's 3,000 that's still sitting there. So you get to keep that money and it rolls over year after year, and that account continues to grow. And it basically becomes kind of like a secondary, side retirement account, because after you have $1,000 sitting in cash, you can invest anything above and beyond that. So in my example, you put 3,500, you use 500 for medical expenses. 1,000 needs to sit there in cash in case you have medical expenses. Then the other 2,000 of it you can invest. And like I said, so on and so forth every single year. So it could be a great way, one, to invest money, additional place to invest money. So additional retirement savings, tax savings. But like I said, it also comes with that high deductible health insurance plan. And you need to understand, like I said, health-wise, what you're willing to do as it pertains to those expenses.
I see Ilana's question about are child care expenses as an athlete deductible? Okay, for you, Ilana, it can be deductible because you have a corp, and the child care, you can add child care expenses as a benefit under your corp. For unincorporated athletes or unincorporated taxpayers, it would be subject to, you can get a child care expenses wouldn't be deductible, so to speak, but you can get a dependent care credit on your tax return for that. But if you want to run that through your corp, you can set up a, quote unquote benefit plan, or what do you call it, dependent care benefit plan under your corp, so that you can deduct the child care expenses. But we can talk more about that because there's some W-2 reporting we'll probably have to set up for that as well. But that's the beauty of having your corporation, where you can set up these different benefit plans, and you as the employee get the benefit of it. You as employer and employee. All right, any other questions? You feel free to chat or, unmute and ask the questions.
Grant, you've been quiet. He's like, I'm going to continue to stay quiet.
Yeah.
You muted.
I'm sorry, I was trying to unmute him. Okay,
yeah, I was making some lunch earlier, so I was, and I'm kind of in the dark, so.
No worries.
But yeah, thanks guys for doing this. I don't have any big questions, but thank you.
All right. I would say for those who've gotten PP loans, let's see, maybe just one of you. There are some, depending on who the lender is, there's different requirements, stuff that we have to show. But for those who are incorporated, the PP loan, the documentation we need to show is going to be fairly straightforward. It's just payroll reports. Where it gets tricky is for unincorporated Schedule C filers, where it would just depend on the lender what they want to see. I've seen one requirement they wanted rent checks you paid for your personal rent and things like that. Utilities, since you don't pay yourself a salary, what we've been telling some of our incorporated clients is just to write yourself a check or transfer of funds from your business account to your personal account and notate it owner salary or owner draw or whatever, or owner pay, so that it's clear that you're taking a pay from your business account. But there's been so many changes to the PP loan forgiveness process that, when we started, I think we were starting the PPP loan forgiveness process from some of my clients in September, and then there were some more rules that came out, some more changes, and we were just like, let's just forget it. Let's just wait till the end in December to wait till things solidify a little bit more. So as we get more guidance, we'll start the PPP loan forgiveness process. But just a caveat is that, while the loan is forgivable, the expenses that were used, that was funded or that was used to cover the expenses for which the funds were covered won't be deductible on the tax return. But that makes sense because the loan has been forgiven, it'd be like double dipping, right? You get a loan that's forgiving and then you're taking deduction for those expenses. So right now, the IRS guidance is that those expenses will not be deductible on the tax return. So we may have to do some little tax planning there because our expenses won't be as high as they were in previous months. But the benefit to that was that you were able to use not your cash to cover those expenses, okay? But we'll be sending out communication on that as we start going through the PPP loan process. So it's still an ever evolving kind of situation there. And then hopefully, I'm hopeful now that that the election madness is all over, that maybe there'll be a third round of PPP funding, maybe. I know they're talking about more COVID relief funding for small businesses, and we're hoping that there'll be that the PPP loan will be renewed, but there's just a little bit of chatter. It's nothing concrete yet, so I can't even say that that's going to happen. But if it is, for those who didn't get through the first round, we're gonna resubmit again for the second round. We're just gonna automatically resubmit for the third round in this case of funding. And I mean, that was a whole fun process, as Lauryn probably can attest to as well. We had a time working with lenders, and I know Tracy had a few choice words for lenders who approved loans for our clients and they came back and denied it for just blanket reasons. I think in all, they just were getting overwhelmed with all the applications, because there was no reason for any of our clients not to qualify for a loan. But yeah, Tracy had some choice words. I've had choice words because it's just a pandemic. We need to get our clients their funds. So, but we are staying abreast on that. So I just want everyone to know that. And I'm saying that for the benefit because we're recording this video for the athletes who couldn't attend, and we're going to be sending this link out and the recording and the PowerPoint presentation. So hold on, if you didn't get a PPP loan, just hold on. We're still hanging tight with that as well.
Yeah, I'll jump in here too and just mention that sometimes athletes, one of the things that people came back to me with was, well, I'm not really struggling. Is it right to take this money sort of thing? And like I said, once again, we're always looking at your full financial picture and we're looking at, what's to come and what can be. So while you may not be homeless right now and, there are people that you feel like might need it more, allotment wise, you're eligible for it and you should take advantage of the things that you're eligible for. If you don't use them, you can return them. But we also, like I said, don't know what's around the corner. This year was like, I'm tired of hearing the word unprecedented, but we've heard it so much. And, it's better to be safe than sorry as it pertains to not knowing what could happen to you in the future. So, it's always up to the person and their values and what they. But the main thing I would say is that you're not stealing money from someone. These are government allotted funds and there's a criteria which you meet. So you are eligible in and of itself just because of that. And like I said, what is the thing that you can't see coming down the pipeline in the future?
Right. And then, you gotta look at the spikes. There's been more spikes in COVID cases or increases in cases. So, we may be going into a second, third, fourth wave, who knows? So you just wanna be prepared,
Courtney, I see you turning camera on.
Wanted to show I was, listening. I was like Grant at the beginning and making lunch, so didn't want to, be distracting. But no, the loan stuff's really helpful because obviously I've been going through all that, and I do still have questions with the EIDL, but I don't know if we should talk about that like here later on, but. Because I received notice that, it is beginning to, gain interest in terms of like what paying on it. So I didn't know if you guys are still recommending, like you said, to hold on to those sums of money just in case, because we don't know what next year looks like, or, that's a case by case kind of situation.
Right. So so definitely recommending to hold on to it. Interest rates are very, very low.
Okay.
So that's the one thing is, like you said, we have some time, some wiggle room, one before the first payment is due, but then also the idea that the interest rate is low, that you're not paying a whole lot. So if we stretch this out over the 30 years that you repay, it's going to cost a lot of money. And the idea would be obviously not to have to do that. But until the uncertainty and things have kind of settled in such a way, it's worth kind of the cost, or, it's like insurance in the sense, it's interest, but what we have is insurance in case like poop hits the fan in some ugly way that we don't have. And I think that is definitely worth paying for.
Okay.
That's a good question too, because Lauren, there's some athletes that we didn't apply for the EIDL loan for them. Either they weren't interested or just wasn't sure if they should take it. If they qualify, your recommendation is to, like you said, to take it.
Take it and sit on it. You can put it in a separate account so that you're, like you said, you're not spending it. It doesn't get all mixed up and you're not confused. And it's as simple as just writing a check in that full amount right back. Once you feel like, okay, things are better and life is okay and we'll be fine.
Yeah.
Can you guys actually talk a little bit about that? Because I don't know what you're talking about.
Oh yeah, the EID loan, that's the economic injury disaster loan. Now the EID loans, they're there for any disaster, natural disaster. So let's say California, we always having wildfires, we're always on fire every year. So if your state or area was declared a disaster area, federally declared disaster area, SBA has these loans that you can qualify for, okay? With COVID, it was the same thing. With COVID, the EIDL loan, these loans became available and they had lesser of a criteria than the regular EIDL loans. I mean, they less stringent requirements that will, so the funds can get to small businesses a lot quicker, sooner. And to qualify for the EIDL loan is basically, to be disqualified from the EIDL loan, you couldn't owe child support or have defaulted on a government loan or be on probation or have any kind of record or things like that. But you have to show, or you have to basically sign or test that you are, that you're in need of the funds or that you're uncertain about your economic future because of COVID. So based on that, we submitted some loan applications for several of our clients who qualify for the EIDL or the PPP. And that's what we're talking about. It's a loan that's, I think it's a 2% interest or 3% interest. You don't have to pay on the loan for 12 months, I believe, or 6 months. I get the terms mixed up with the PPP loan, but it's a very favorable loan and it's low interest. You don't have to start paying on the loan for several months. It's just to help businesses stay afloat because we're, approaching an economic catastrophe with COVID. So that's what we're referring to.
So would that be something you would need to be incorporated for to apply for, or is it?
No, you don't have to be incorporated to get the loan. You could be a sole proprietor, Schedule C filer. They ask for, a couple years tax returns as a Schedule C. They'll see that, but you don't have to be a LLC set up. It's easier if you're LLC or corporation, but you don't have to be.
Okay, thank you.
Yeah. Boy, this is an easy crowd. No questions?
Because we covered it all. We were awesome.
Lauryn and I, we usually do these seminars at the USATF annual meeting, and they're not having that this year, clearly, huh? Probably not.
It's virtual, so yeah, they.
Oh, okay, it's virtual, okay. And we'll do with the emerging elite athletes, we'll do a tag team seminar. She does the financial plan, sort of like what we do today for the up and coming athletes. I enjoy it very much. I look forward to it every year, and we try to keep it interesting, engaging with the young athletes. But one of the things we see is like when athletes are coming out of college and they get these contracts, that's the most money that like most college athletes see in a long time because you spend 4 or 5 years being poor college athletes. So we want to try to grab them where they're young and be like, okay, let's get you steered in the right direction. You got to think taxes, you got to think planning, you got to think savings, and that's kind of how we work with a lot of the young athletes to get them on the right track early. All right, if there's nothing else, Lauryn, I'll let you have the last words and we can wrap it up. If you're interested in the recording, we'll just send this out to Trace will send this recording and the PowerPoint link out to the same invite if you want to keep it and save it for future reference. But I'm sure we'll do another one during tax season or something like that. If anybody is interested, for those who missed it as well. Go ahead, Lauren.
I was just going to say thanks for having me. Thanks for showing up, those who are here present with us today. And like I said, don't hesitate to reach out if you have questions. I am happy to help.
All right. All right, guys, enjoy the rest of your week. Stay safe. Thanks for joining us. We appreciate your attendance. Thanks so much.
Yeah,
Thank
thank
you,
you for
guys.
doing this.
Yeah, no problem.
Yeah, thank you guys.
Tanisha, you owe me a call back.
Oh, yes. Thank you. Yes, I'm sorry. I'm still out of town. I'm quarantining in Houston. So yeah, I'll give you a call back. Okay.
Okay.
All right. Okay.
All right, cool. Bye.
All right. Thanks. Good night, guys.